Great. So welcome you all once again to today's section. Today we're going to look at for three items. The continuation of IAS 2. Then we will start and finish IAS 10. And then we will start and also finish IAS 12. This is the agenda for today. Good. So let's see. Last time we ended at what? The initial measurement of what? Inventory. Good. So last time we ended the initial measurement. So let's quickly go through the subsequent measurements and then we will start with the IAS 10. Good. And then the IAS 12. All of this, there are tutorial videos on them. So I'll share that one also with you. So if you want to get a full picture of them, I will, so that you get the detailed understanding. But here we are looking for under the financial statement preparation. Good. So that is it. IAS 2 inventory. We said that we have the initial measurement of inventory. And we said that initially inventory must be measured at what? At cost. So initially it must be measured at cost. And we look at the composition of cost. Good. So that's the initial measurement. Today, today, we're going to look at what? Subsequent measurement. Subsequent measurement of inventory. Now, when you talk about subsequent measurement, it means that measurement after the initial recognition or the initial measurement. If you acquired your inventory today, maybe 1st January or around October there, you bought some goods. Yeah, the standard is saying that how do you get a value? Initial measurement, it must be at the cost at which you acquire the goods. Subsequent, the next reporting period. That's what you mean by what? Subsequent measurement. That is the next reporting period. So December, and we bought it 2018. So October 2018. October 2018, December. That's your next reporting period. What will be the value? And the subsequent one as well. So December 2019, what will be the value? So that's what I mean by what? Subsequent measurement of inventory. All measurements, but we have two. We have the initial and what? The subsequent measurement. And all initial measurements, most often, they are at what cost. So subsequently, how do you get a value of your inventory? That is the subsequent measurement, because we said that measurement basically talks about value, valuation, how you arrive at the figure to be placed on it. Recognition talks about how you're going to record it, what type of element. Good. Now let's look at the rule. In fact, if you don't understand anything in IAS, not the subsequent measurement, not what we're going to do. So it's very important. Subsequently, compare two items and select the lower. So inventory must be measured at what? The lower of what? Cost and net realizable value. So inventory must be measured at what? Measured at the lower of two value. Compare two items and select the least among them. The lower of costs and net realizable value. Net realizable value, popularly known as NRV. NRV. Good. So that is it. So basically, compare and select what the least among these two. We are done. So the lower of cost. I hope we can select the least or the lower among these two. Yes, you are going to use figures or numbers and you select the least one. So that is it. Now, let me do some short presentation here. So basically, the subsequent measurements, we are saying select what? The lower of two items. Compare the cost of the inventory to that of what we call net realizable value. Net realizable value, popularly known as what? NRV. So inventory must be measured at lower of this value. So select the one. So if here 18 and 15, oh this one, this type of inventory, you have to measure that what? 15. That's all. Now let's see. Good. Now the question is, how do you get this cost? How do you get a cost? If you're going to pick each of these items one after the other, then we start solving questions on them. So cost. Here we have what you call the cost formulas. The cost formulas. There are certain methods that we can use to arrive at what? The cost of the inventory. What are they? So these are the cost formulas. One, you can use the actual cost method. So actual cost. This is the one coming from where? The initial measurement. That's the actual cost of the goods. Can use that one. Two, can use what we call FIFO. FIFO. First in, first out method. First in, first out. Two, can also use what we call weighted average cost method. Weighted average cost method. So that's the, and this one too is FIFO. Or you can also use the standard price. However, LIFO is being banned by what? IAS 2. We call it last in, first out. First out. So we call it LIFO. IAS2 have banned this, so LIFO is not part of the cost formula. So that is it. Actual cost is what you know. This one is coming from where? The initial measurement, which comprises of what? Three items. What are they? The purchase cost, mhm, thank you, directly attributable costs, and any other costs incurred necessary to bring the inventory to its intended use or intended sale. That's it. We are done with the cost formulas. So these are the way. So most often, we will give you the actual cost of the goods. Or if you are selling varieties of goods, then it means that you have to use the first in, first out, or the weighted average. Then you are done. For those who want to take IFRS into detail, the US gap, they acknowledge the LIFO in here. They still maintain the LIFO. Good. So that is it. So now we know the cost. So the cost that we calculated under the initial measurement, they are the same. That's if you are going to use the actual cost method. So that is it. Now let's go to the NRV, net realizable value, NRV. So let's go to NRV. Let us explain the NRV. Sorry. Now let's go to the NRV and let us explain the meaning of NRV. NRV. Good. Now, if you mention NRV, what is the meaning of that term? As the name suggests, net realizable value. Good. Net realizable value. In fact, if you have assets and then if you any amount that you are going to recover through sale or the use of a particular asset, that one will be termed as what? Recoverable amount through sale or through use. But here the NRV, we are talking about through sale, net realizable value. So NRV simple means amount that you recover from the sale of an asset or a particular asset. So NRV, so let me bring it here. So NRV is the expected amount to be received or recovered. Received after sale of here asset. Here you can say asset, but because it relates to inventory, sale of what? Inventory. So we use inventory. Sale of inventory. That is the NRV. So expected amount to be received or realized or recovered through sale of what? Of inventory. That is NRV. So if you have a particular asset, if you should sell this asset today, how much are you going to realize from it? The net means less any selling cost. Afterwards, any selling cost. So expected net amount to be received after a sale of what? Inventory. Net means less what? Any selling cost. Yes, from that asset. So that is the NRV. Good. So expected net amount to be received after a sale of inventory. Good. Now the definition, we normally use the formula. Now you have to mention expected in NRV because they are not actual. NRVs are not actual. What you expected to derive or receive from this sale, that does not mean that if I actually made that sale. No, it's what expected. Okay.
So if I get it, means that for the recoverable, you have recovered it. It is actual. Is that it? Or that one is the recoverable value.
Recoverable amounts and NRV, net reserve value, all of them are expected value. They are expected value. Something that you expect to receive after the sale of the asset. When you sell the asset. If I should sell this asset today, how much will I receive from this asset?
Are they the same?
It's the same as what? NRV.
Oh,
NRV is what? Expected. So we have to see the word expected in your definition. Good. So the definition or the formula for calculating NRV is expected selling price or sales value. So expected selling price of the inventory or expected sales value. Expected selling price or sales what value of the inventory. Expected sales value less so much less what expected cost to complete. Expected cost to what? Cost to complete so much. Then less what? Expected cost to sell the inventory. So this will give what we call NRV. So this is what? Net realizable value. Good. So if you should sell your assets, your goods today, how much are you going to receive from them? Please, that is not actual. That is not the realized. Good. So expected less expected. So you can see expected three times. So the standard IAS 2 inventory define net realizable value as what? The expected sales value less expected cost to complete and cost to sell. That is the definition stated. But the actual meaning of NRV is the net expected amount to be received afterwards after sale. So in examination or in question, if you are looking for the NRV, let them give you these three items so that you can calculate yourself, or they have to state it like NRV. If any of these four they are not there, it's not NRV. Let me take it again. In exams, they have to give us any of these what four items. So they can give you the expected selling price, then expected cost to complete. That's all. You can still get the NRV. Or they have to give us the NRV straightforward. Good. If you don't see any of these four there, that is not the NRV. Good. So that is it. Now let me do some small issues here. Now let's bring the composition of cost or inclusion of cost that you compare. It must comprise of what? Purchase cost, so much, and then directly attributable cost. That's the convention, right? Those are called convention cost. That's the name. conversion costs, and any other costs. Any other cost. So this will now give her the total cost of the inventory. Then you compare this figure to this one, then you select what? The lower. You are done. That is the game. Good. Now, distinction has to be made between these conversion costs and their cost to complete. They normally look alike. They're almost the same, but they are not the same. Now, all these costs are actual costs. They are actual costs that you've incurred to date. All this one, they are costs that you've incurred or to date. So if I want to get the value of this marker, if I sell markers, okay, I ask myself, what's the cost of this marker? Okay, how do I got this marker in my workshop? So the cost I incur, okay, purchase cost, maybe I do some work on it. Any other cost? So one is 80 pesos. That's my cost, 80 pesos. Good. Then when I go to the NRV, if I should sell this marker today, what will be the value that I'll receive or generate from the sale after I take or consider all my selling costs? So let's see. Okay, expected sales price. Okay, if I sell today, this marker will go in for one CD 20 pesos. Good. Is there any expected cost to complete? Cost to complete means, subsequent measurement. These goods that you are selling, they are not in a good shape, or a good state. Let us know you are selling rice. You bought the rice, let's say 2 years ago. Some of the sacks look old. So I have to change all the sacks. Or I have to change the cover, the color. That's the cost to complete. That does not mean that I'm now going to what? Manufacture the item new. No, that's not that one. Good. Now, expected cost to complete. Expected cost to complete is the cost that I have to perform, or the work that I have to perform on this marker before I can sell it for that amount I'm quoting for. Good. Now, if I should sell this, let us know one customer said that I want a marker that the color or the packaging is red, but this one is white. So let me change the color. So I have to paint, maybe change the color again, the label, and it will cost me 1,000 Ghana. Good. That's the cost to complete the sale. Now, when you come to the conversion cost, this cost is the cost that I will incur to bring the asset to its what sellable condition. Just that this one I've already incurred is a past cost. I've already incurred it. This one is a future. All these items are future. That's why we use the word expected. 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 These are actual costs. If you incur them, these costs you have incurred them to date. Because there's a question that you're going to solve now. If care is not taken, we may change their position. Bring cost to complete here and conversion cost there. The difference is clear. This one is future if I should sell it today. This one is incurred to date. Cost that I've incurred to date. Let us know that I manufacture the marker myself. Purchasing, I'll go and buy the raw material. Good. Conversion cost, the production cost. So that's why we are adding production cost to what? The cost of the inventory. So the production cost is here maybe 10 Ghana cedis. Other cost 5 cedis. I bought the raw material. Each one I bought it for 8 Ghana cedis. So putting all this, you get 23. So that's the cost. This is what I've incurred to date. Now, if I should sell this one and have to perform another work, extra work on these goods before I can sell it, that extra work is called cost to complete the sale. Good. It That cost, I'll only incur it if I want to sell the goods. That is it. That's what we call it, cost to sell. That product, I've already completed it. Just that this customer wants a different package. This one wants a different package. Good. Now, assuming that the rice that we sell local rice. The sacks got torn or it's not nice. So we decided to acquire a new sacks and then put the rice in. In fact, the local rice, right? You go and buy Uncle Sam or Royal Aroma, the sack. Then put the local rice in it and repackage it again. Now that sacks becomes what? Cost to what? Cost to complete the sale. Good. So that is it. Then we have expected cost to sell. That's the selling cost. Maybe you sold this goods through agents. So agent commission, maybe discount, you give a discount. All this will form part of what? The selling cost. You take all this from where? The sales value. Then you arrive at what? The NLV. So that is it. That is how we will solve the question. Good. Then you compare. So let's try our first illustration. Good. Unfortunate for you, you are trying the first one. Good. Now we go to question 3A. So just the question 3A. So you are required to value the following items of inventory. You are required to value the following items of inventory. All of them are different. So item 1 is different from item 2. So item 1 or the A, materials costing $12,000 bought for processing and assignment for a profitable special order. Since buying these items, the cost price has fallen to $10,000. Good. So how do you value this item? Good. Now let's see. Any trial? Okay. Good. But before that, I want to go straight for it, so I didn't go through the examples. There's one example, example one. So you can try the example one, but I'll go to the 12 questions first. Now here, will it be 10,000 or 12,000 or 2,000 or none? Now let's see. We said that to value inventory compared to figures, the cost and then the NRV, you are done. And we said that the NRV, they have to inform us the selling price or they have to give us the NRV straightforward. They have to name it that this is the NRV before we can use that one as what? NRV. So in this question, the cost is what? 12,000. They bought it for 12,000 because we said that cost is actual if you incurred it. So 12,000. The NRV is expected. But since buying this item, the cost price has what? Fallen to $10,000. That's the cost price that's fallen from 12,000 to what? 10,000. Good. So that 10,000 is called replacement cost. If I should replace these goods again, I'll spend 10,000, not the 12,000 I bought them for. So that's replacement cost to replace these goods. But here we didn't say that it should be the lower between the actual cost and replacement cost. No. So here in this question, the cost was 12,000 Ghana cedis, NRV dash or not given. NRV wasn't given in this question. So the 10,000 is not NRV. The 10,000 cedis is not the NRV. Why? Because they didn't mention selling price is this or cost is this. Or they didn't even say that if I should dispose these goods off, I'll get this. They are saying that if I should go and buy these goods again, I will buy them at 10,000. So that becomes what? Replacement cost. So NRV is not given. And if it's not given, you have to select this to be what? The value of the goods. So here the value must be what? 12,000 Ghana cedis. 12,000 Ghana cedis. Great. Now let's try the B part. It's the B part I don't want to clean the board. Let's try the B part. Let's use just 2 minutes. Try something. Put something together. The B. The B. The B part. Let's put something together. The B. Now let's try it together. Good. I hope you paused the video. Now let's look out for the costs and then the NRV. We are done. So first, but let me clean everything.
And then NRE.
Okay, good. So now let's see. What's the name of this inventory? Sometime we'll name it for you. Equipment constructed. So I'll tell the examiner that I am measuring what or valuing the equipment. So I'll select what lower. I'll compare two items and select the lower. That's the cost and what and now. So I'll go to the question. Sometimes if you're lucky, we just give it to you just one figure, you are done. If you're not lucky, they have to give you the breakdown. You have to get a breakdown together, then you are done. So if I read every sentence, you pause and come and put them in. So equipment constructed for a customer for an agreed price of what? Thousand. So $18,000. So that is the 18,000 becomes what? Is it the cost price or the selling price? At agreed price. Agreed. Agreed selling price. So the 18,000 is what? Is the selling price. Agreed price. If we are preparing something for someone and then at an agreed price, what will be the value of that one? So that is the selling price, estimated selling price at an agreed price. So I'll come here and put estimated. What expected there? But must be estimated selling price. Selling price, which is dollars are here 18,000. It's an estimate or expected. Now let's continue the game. So if I reach more, I bring it. Eight. Hey, I think I'm reading from different section. There's no eight here. Oh, yes, there's eight here. Okay, this has recently been completed at a cost of what? 16,800. This has been recently completed at a cost of what? 18,000, $16,800. So that one becomes what? Okay, it has been completed. It has been completed. So that's the total cost. So completed cost. So that means putting the purchase price together, conversion cost, any other cost, everything together, the completed cost 16,800. That is it.
No cost to complete.
Okay, cost to complete.
That's future.
Cost
And
to
this one
com
is
cost to complete means is the cost that the works that have to perform on the job or on the event before I can sell it. So that one is in future. But the actual cost if you incur, that becomes what? The total cost. So this one, yeah, it must be cost that you incur to date. All this, they are what? Cost incurred to date. Either will give you the breakdown, but here they give us the total. No breakdown. No purchasing of inventory. No conversion cost. No any other cost. They've just sum all of them together. It has been completed. Once you have completed it, it has passed through all the stage. It has been completed. Complete. We bought the raw material. We've worked on it. So we are done. Now let's continue the game. So this is the total cost. So I'll place it here. Now let's continue the game. It has now been discovered that in order to meet certain regulation, conversion with an extra cost of $4,200 will be required. The customer has accepted partial responsibility and agreed to meet one half of the extra cost. So this
meat
ex
half, not one half.
oh, okay. Meet half the extra cost. Okay. Now the cost is $4,200 and half of it will be what? 2,001. Now this cost, how are you going to treat it? Will it be cost to complete or convention cost? This is cost to what? Cost to complete. Extra cost must be incurred. So any extra work that you have to work on the artifact before you can sell it, that's what? Cost to complete. Any extra work. Because the product that you are done has been completed. What's the work again? But to meet the customer's demand or state laws or regulations, you have to incur extra cost on them. So this is what cost to complete. So less estimated cost to complete. In fact, I use expected, but I like estimate more than the expected in the formula. So less what? Estimated cost to complete. Therefore, I'll take my calculator and then take half divided by 2. So I get 2,100. Agreed. So therefore, what is the NRV? So NRV will give us 15,900. That is the NRV. Good. So therefore, this inventory should be measured at what? Lower. Compare these two and choose what? The lowest one. So this and this. You have to select one. 15,900. So the value of these goods must be what? 15,900. 15,900. That is it. That is it. Good. 15,900. Now let me look at one few issues. Then we continue the question solving. Then we come to the accounting treatment. I think I'll start the accounting treatment first. Now look at the last issue. Now, anytime NRV happen to be the lowest one, it calls for an accounting treatment. Anytime the NRV happen to be what? The lowest one, it calls for what? An accounting treatment. So anytime NRV happen, like for instance here, NRV is lowest. Oh, then it will cause for a special treatment. But if the NRV is higher or the cost is what? Lower. So assume that here happen to be 14,000. What do? You do nothing. It does not cost for any special treatment. You tell the examiner that inventory must be measured at what? 14,000 or valued at 14,000. We are done. It ends there. No accounting treatment again. Now, what happened that NRV happened to be the lowest one, then there's a danger. You have to account for it. We said that this cost is in the books. It has been recorded. This is recorded figure. It's always a recorded figure. That's the actual. It will be in the books. This examination purposes is the one that you see in the trial balance. So the cost of inventory or the inventory you see at trial balance is the cost. NRV, because it's estimates, it's an estimated figure, not actual. It will not be on the trial balance. It will be where? A footnote. Good. That is it. So now it tells you that when the guesswork, the estimated figure, or the expected figure happen to be the right one, the best one to use, they have to make some changes in our book. Because in the books we have record what? We have recorded what? The cost 16,800, but it happened to be the highest one, which violates what? The rule. So what do? You have to perform some magic or do some things to change the recorded figure, the wrong one, from this 16,800 to what? 15,900. So it calls for accounting treatment. But if it happen that this is the lowest one, what do? You continue because you have recorded that 14,000 and it happened to be the correct one. So do nothing. Just use this 14,000 as the value of the inventory, then move on. Good. So let's look for, or let's reduce the accounting treatment of what you call inventory written down. So what happened that way? You have recorded the highest figure in your book, which is wrong. So perform some workings or adjustments to move it or to write it down to the NRV. Good. So over here, these are the terms that we are going to use. Let me write them here. All of them are in the same label. One, this inventory, so we call it equipment, it must be valued at $15,900, not the 16,800 that they incurred. Then two, it must be written down to the NRV. Why? Because it's the lowest one, 15,900. Then it must also be written down by, so written down by, so written down by the difference. Kindly confirm for me, what is the difference between 15,900 and then the 16,800? The difference is what? 900. So the difference is 900, right? So it must be written down by what? $900. When you do that, it means that this value that we have here, we have to reduce it by what? $900. It's too much. Good. So that is it. Now let's look for the accounting treatment. How do you treat this in a book when the NRV happen to be the lowest one? The accounting treatment. And these are the terms. Good. Accounting treatment. So you find the written down. That is the difference. The written down.
Sorry, because the attempts are written down to written down by author.
Inventory written down. So what we call inventory written down. Inventory written down. The accounting treatment. Inventory written down. This happened when the NRV happened to be what? The lower. That means you will have to write some part of your inventory off. Take it off. Take it what? Off. So two treatment. Treatment number one. That written down figure is an expense. Add it to cost of sales. Add it to what? Cost of sales and expense. Why that you have some goods there, the value is 16,800, and we say reduce it by 900, subtract 900 from it. So this 900 that you are lessening it is an expense or cost to you. So you add to cost of sales. That is where you have the cost of sales given to you. In some instance, you will calculate the cost of sales yourself. That's one of the questions. We said that cost of sales is equal to open inventory, so much, add what? Add purchases. Less what? This closing inventory. In fact, put NRV here. If you are calculating the cost of sales yourself, then here choose the NRV, less the NRV, not the cost of the inventory. That's all. Good. So if you are calculating the cost of sales yourself, when you go to the closing inventory section, use what? The NRV. You are done. So two things. Either they will ask us to calculate the cost of sales ourselves and still value the closing inventory. That is it. Now, you are done. So I'll take this section off. That's the first treatment. Add cost of sales. Two, this one goes to the P&L. Okay, this one goes to the P&L. Two, subtract it from where? The cost of the inventory. So subtract from the cost. So if I do it like this, 16,800 less 900. That give us 15,900. I've not done anything. So it's the same as me directly or sending the NRV to the financial position. So it's the same as you picking the NRV to where? The statement of financial positions. When you go to your balance sheet, pick what? The NRV. That's all. So in short, this difference, add it to your cost of sales, then send the NRV to where? To the financial position. We are done. That is the treatment. That is it. So that is the end of the accounting treatment. So, but if you compare and then the cost is lower, you do what? You do nothing. Just send the cost to where? The financial position, you are done. You perform this accounting treatment if the NRV happen to be what? So that is it. That's the treatment. Now let me explain the last item, then move on to the question solving to end IAS2. So we are done with IAS2. This is the section. Now, what are the circumstances or the instances where the NRV will be lower than the cost? So what will happen before the NRV of the goods will be what? Lower than the cost. We said that NRVs are what? Estimated value that we are going to arrive when we if it's to sell this asset. So what will happen before this marker that I'm holding? If the cost is 80 pesos, so what will happen? That will let me arrive at what? The NRV will be what? Lower than the cost. So let's see. First, damage goods. Damage what? Goods or outdated goods. Assume that you are selling goods that are not in good shape. Accident cars. Look at the price of accident cars. Sometimes far below the cost. Yes. And then outdated goods. Imagine you selling 1999 Jeep, the amount that you realize from it. Or 1960 vehicle, the amount that you realize from it. It will be far below the cost of the goods. So that's a factor. So that's number two. Now, it can also be as a result of what? Reduction in the selling price. As a result of reduction in selling prices. Good. If you reduce your selling price, the NRV will definitely be lower than the cost of the products. If you reduce it significantly, good. So that is a factor. Then it can also be as a result of what? Management intention or management strategy. Like what happened between Coke and what? Pepsi. Coke and Pepsi. Pepsi said that still one city. My Coke said, okay, let's reduce our price to what? One city and go and then compete with Pepsi. And Coke did that. So they realized that the NRV was lower than the cost. So the write-off was too much. So now they started increasing it. And when increasing, they even double it. From one city, now they come to what? Three cities. From one city, came to three cities. So it's from two city, dropped to one city, and now they add all the loss to it, and then they come again. So sometimes the NR will be lower than the cost as a result of what? Management intention or management strategies. It also talks about reduce to clear. Getting to Xmas, we thought that okay, 60% off. Even though sometimes some of the products are closer to the expiring date. But in genuine cases, some of the goods they are very in good shape, but they've reduced 60% of the price. Definitely they will not get the cost. The NRV will be lower than the cost of these goods. So these are the circumstances where the NRV will be what? Lower than the cost price. Good. So that is it. Now we are done with IS2 inventory. I want to leave with question solving. So we go to success limited. Now, how would they ask the question? under the final account, if you're preparing financial statement. We've gone through the accounting treatment, so let's back with illustration. So you will try 2 questions for me, and then I'll go to success to end the game. Let's go to success limited. Success limited, and then it's war and Ubuntu. So let's go to success limited. Good. Now let's jump straight to success limited. Success limited. Good. When you check to the trial balance, you can see cost of sales. One, there's cost of sales. Any inventory figure is what? Is a closing inventory. I can see inventories here. That's the cost of the closing inventory is 41,200. Good. If you go to note 1, it says that the NRV, the net realizable value of the inventories as at 31st March 2019, estimated to be 37,300. That's 37.3 million. Good. So here you realize that the NRV is what? Lower. So you compare this NRV to that of what? The cost. So the cost is 41,200. So this, it means that it must be written down to the NRV, because the NRV is what? Lowest one. So what will be the accounting treatment? Now let's see the accounting treatment on the board. So for success limited, all what I have to do is, and I go to my cost of sales calculation, because here the examiner performed the cost of sales already. I'll go to my cost of sales. You have to do this if the NRV is what? The lower. Now let's see. So write your inventory written down. Inventory written down. So I'll put the figure here. Then compare. The cost is 41,200 less the NRV 37,300. Then I'll get what? 3,900. So in my cost of sales, this is what will happen. Then when I go to my financial position, the balance sheet, I write current assets and go to inventory and tell the examiner that the inventory value will be what? The 37,300. We said that is the NRV. If it is what? The least one. We are done. So that's the end of IAS to inventory. How we get? That's the end of IAS to inventory. So now you will try Ubuntu for me. That's question number 3. Ubuntu. So if you go to Ubuntu 2, question 3. Down to the cost of sales. The inventory was named as stocks. So the stocks is what? 34,000. That's the cost of the closing inventory. You go to the first footnote, So that the net reserve value of the stocks after 31st December was what? 33,500. So that side too, there must be what? Everything down by 0.5 million. Good. So kindly do that and prepare the financial statement again for me. That means with the help of note 1, note 2, and note 4. So we've done this note. So note 1, note 2, note 4. So I prepare the financial statement again for input 2. It must balance because you balance it without the footnote. And now we are done with the 3 of the notes. Note 1, note 2, and note what? 3. So that is it. Good. Now there's a question here that I want us to go through. It's called suffer to gain. But that's the last question in the handout. Suffer to gain. Suffer to gain. That's question number 11 in the new one. Suffer to gain. The last question in the handout. Now that question, if you check, there was open stock, there was purchase, there's closing stock. Have you seen this closing stock? It says 12,000, right? Let's go to the footnote and see if this closing stock, the value is 12,000. Last footnote. It's supposed to be 11,000, it's not there. But the net reserve value of the inventories after 31st March 2018, but it's supposed to be 11 million. So I'll put it there. It's supposed to be 11 million. I think I'll update it and then forward it to you. You do have the hard copy, you can put 11 million there. So you realize that here they have given us a breakdown. So when you are calculating the cost of sales, when you pick this cost of sales, then you can just adjust it with what? The difference between the 12 million and 11 million. But if you want to recalculate it again, then you don't use 12,000, use what? 11,000. Because the value of the closing inventory must be what? 11,000. Agreed. Exactly. You're not going to get 12,000. So here, let's try and calculate the cost of sales. Let's see how best we can calculate this cost of sales. So I'll do it here. First, we said that we have to add the cost of sales. So if I should calculate the cost of sales, I'll start. There are two ways you get the same answer. Open inventory. What's the open inventory from the question? Good. So 12,580. So 12,580. Then the purchases. Purchases is what? 92,340. Now this closing event less what? Closing inventory. What do you get for the closing inventory? Now the closing inventory is the 11,000 given to us in the footnote. 11,000. So less 11,000, not the 12,000. Why? Because the cost of the closing inventory is 12,000, but the NRV is what? 11,000. So we have to select what? The lowest or the lower. Good. So this, we are done. Exactly. Exactly. So when you do this, what is the cost of sales? When you do this, what is the cost of sales? So that means the cost of goods sold or the cost of sales 93,920. Good. Now, it's the same as we picking just the cost of sales. So, alternative. So, we can just pick the cost of sales here, calculated already from the question, the wrong one. So, let's go to the question and pick the cost of sales, the wrong one calculated in the question. It is 92,920. Good. So 92,000, that's the cost of sales here. Cost of goods sold, 92,920. So I'll bring that one. So 92,920. And tell the examiner that inventory written down. Inventory written down. So this inventory must be written down by 1,000, right? So that will be 12,000 less what? 11,000. That will give us 1,000. Yes, that's all of it. So 1,000, when I add, so it means that the cost of sales now becomes what? The 93,920. So are we saying the treatment? When you go to the financial position, the balance sheet, when you go to the financial position, that is the balance sheet, you just have to record a closing inventory of 11,000, then you are done. So that is the treatment. This is October 2017 or April 2017, one of the year, April 2017. It's a past question to your paper. Good. So that is it. Now there's a drop. One of the drops contains event. I'll project that one for how to solve the last question. But please, this is your question. Example 5 and question 5 from the handout. Sorry, that part is not coming. Part is not coming. Example 5 and tutorial question number 5. So example 5, tutorial question number 5. Everything is what? 5. So any question 5 you see, kindly try it for me. So let me project again. So when you get a material, not this material, the standards good. So question 5 is here. But I wish you can do question 4 too. No, the standards. Question 5. You are trying question 5 for me. That is ICA November 2017. Then you go to examples. So example 5 2 is yours. Example 5. Everything 5, 5, 5, 5, 5. Good. Wosteless. Then when you are done, then you do as if you are doing or not doing. Example 6. So that's inventory rating of this one. I'll take them. Please, when solving, ignore this 7,200. This section. So this section must be ignored. Okay, I think I can do the update quickly. Good. Good. I've done that. So for the update to you. So you are solving example 5 and example 6. And then question number what? 5. Good. So that is the trial question. Kindly try them and then you'll be fine. But let me go through the drop, go through for me and you'll be fine. So for the stories there, let me just go straight to the main point. Yeah, stories there. Now, it's saying that at the last annual general meeting of Dunso Limited, the shareholders were unhappy about the delay in submitting the audited account to them for study before the meeting. Management of Dunso Limited attributed the delay in finalizing the account to the time spent by the external auditors in auditing the account. It has been discovered that the delay in presenting the account for audit is because the account officer was not sure of the treatment of the following transactions in the financial statement of Mutual Limited for the year ended 30th June 2017. Not sure. That is the drop 3. So I'm just considering the first part. Stocks of raw material and finished goods in a company's warehouse have the following details. So first, it's in thousands. Direct cost is 50,000. Should it be part? Proportion of the fixed overhead, 10,000. Should it be part? Proportion of selling expenses, should it be part? And then the net realizable value is 62,000. So NRV has been given to be 62,000. The direct cost is 50,000. Proportion of fixed overhead is what? 10,000. And then proportion of selling expenses, 5,000. But what about the fixed overheads? Fixed overheads. In fact, fixed production overheads, but the production is not counted. Good. So here the cost will be, direct cost will be part 50. Fixed production overheads or fixed overhead will also be part, making 60. That's all. Then you compare it to what? That of the NRV of 62,000. So here the cost of this finished goods is what? 60,000, but the NRV is what? 62. So the inventory must measure at what? At lower, 60. So here no adjustment should be made. They should carry it at 60. The proportion of the selling expense should not be part. So that is it. Great. So that is the end of IAS 2. So now we are moving on to a new standard. I'll take like maximum of 10 minutes to finish that standard. Then move on to the last standard for the day. Now let's move on to the next standard. It's called IAS 10. We are jumping to IAS 10. So we are moving to IAS 10. What is IAS 10? It's a very short standard. It's called event after reporting period. So IAS 10. Events afterwards reporting period or date. Event after reporting period, IAS 10. Now, let's see the game. IAS 10. Let us know that your financial year end on December. Let's pick 2019. So 2019, your financial statement start at January. Where will it end? December 2019, that year, the financial statement will will end. So December. So where will we prepare the financial statement? 2019 financial statement. Why are you going to prepare it? Is it January or December 2019? So December 2019, the financial statement must be prepared. Must be what? Prepared. So you call it preparation date. So preparation. That's where they prepare the financial statements. Then, why do you think they will publish the financial statement? Is it the same day or maybe 2 weeks later? When will they publish the financial statements? They publish in January. Okay. Mm-hmm. In fact, by the end of the first quarter of the next period, the financial statement must be ready. So they'll publish it ending of what? March. March ending. March ending. So they have to what? Publish the financial statement. So we call this one publish or issue date. So that's where they will issue the financial statement to the general public or for general public's consumption. So that is so 3 months after preparation date, the financial statement must be what published. Then the question is, what are they between these dates? What will happen? Why will you prepare financial statement today and it take 3 months before you can publish it? That's what auditors have to what do their thing on the financial statements or authenticate it before you publish it. So that's the auditing stage. So auditing will start, and as soon as the auditors finish, the directors will sign, and then they will also sign, and the financial statement will be published that very day. Now, any transaction which will occur between these two periods or these two dates, they are referred to as what? Event after reporting period. So it must occur right after they prepare the financial statement, but just before they publish it. So between these two dates, they are called events after reporting period. Good, that is it. So now let's define event after reporting period. So these are what? Favorable and unfavorable events which occur between the date at which the financial statement is being prepared and then the date to the financial statement being signed or issued or published. That is event after reporting period. So any transaction which occur between these two dates. Good. The rule is saying that it must occur after you prepare the financial statement, but before you publish it. All that happens there, they are what? Event after reporting period. So it means that all the transactions that happen January, February, and even March, just before we publish the financial statement, they are what? Event after reporting period. All of them, they are event after reporting period. Good. So we are done with event after reporting period. There are two types of such events. There are what? Two types of such events. Now let's look at them. We have what we call adjusting events and non-adjusting events. As the name suggests, adjusting event. Some of the event calls for adjustment. So types of event after reporting period. We have one adjusting event, and non-adjusting event. Now let's explain adjusting event first. Now, adjusting events, they are events after the reporting period that provide evidence of their existence before the year end. So the transaction will occur here, somewhere here. but this transaction will provide evidence, or there will be some sort of evidence that this transaction exists before December. If that transaction is there, just that it has not what materialized, or it has not occurred. Good. So that is what events after reporting period. So let us assume that you've made a sale, huge sales, or you purchased some power badges, like the way Ghana are on spend like years on the scene. Let us know you purchased some power badges. Maybe you signed a deal December 1st, but they will promise you that they will deliver these goods to you before the year end. If you receive the way bill, everything, all the documents about the goods has been sent to you, just that the goods themselves have not arrived. But they promise you that on 20th of December, the goods will arrive safely. Good. In fact, on 20th up to 31st December. No, no, no. Good. So if the goods arrive 15th January, then this goods should be classified as what? Event after what? Reporting period. But here, it's what? Adjusting event. Why? But there's an evidence that this goods exist before the year end. There's a document. There's a proof that there's goods, but just that the physical presence is not there. That is it. Now, what's the accounting treatment of adjusting event? As the name suggests, adjust the financial statement. Why? Because this 2019 financial statement, you prepared it. So this transaction, which occurred here, but there's an evidence that there's this before the year end. So you have to call for that financial statement and make adjustments. So you have to record it. So the accounting treatment will be what? Adjust the financial statement. If it amounts to adjusting events, you have to what? Adjust the financial statement. Good. Now, all what you have to go through or be aware of is this. You should know some specific examples of transactions or specific transactions which occur after the reporting period that amount to what? Adjusting events. In exams, out of this specific example, you see some of them there in your question. Then you adjust. The first example, we will discuss about five. The first example of adjusting events is asset, written down value of an asset. Written down value of what? Assets. So that's the first example that we are going to look at for. So examples of adjusting events. One, written down value of what? Of assets. So it can be receivable or it can be inventory. Let us assume that you have inventory. And shortly after the year end, you sold these goods below their cost. Maybe the cost of the inventory, the closing inventory, had a cost of 40,000. So that's what you've included it in the financial statement at 40,000. That was the cost. 20 days after the year end, you sold these goods for 35,000 Ghana cedis. Now, here there's an evidence that this goods that is recorded, but the goods has been paid. So, in fact, adjust the financial statement. So, event written down after the year end, shortly after the year end. And if these goods were exist, or if these goods form part of your closing inventory, which has been carried forward next year, and you dispose it of below its cost, So that means the NRV is lower than what? The cost. So you have to come back. Assume that the NRV after the year end is what? 35. So there's even written down of what? 5. So account for this 5 in 2019 financial statement. Even though you actually sold the goods when? January, after the year end. So that is it. So even written down after the year end. Another clear example is what? Bad debt after the year end. Let us assume a customer, total people owing you is 200,000 cedis. That's your receivable. Out of this, a certain customer is owing you 10,000. After the year end, that customer decided to die. Yes. It means that you have to write off that debt. So there's evidence. Even though the customer died here at this date, but out of the amount that is owing you, there's an evidence that this debt, you're not going to receive it. It has been impaired. So all what I'll do is write it off. So in short, bad debt after the year end, bad debt right after the year end, or a customer losing business as a result of what? Bankruptcy or maybe COVID-19 issues. That debt must be what? Written off from the pool. Or that debt must be accounted for as what? Adjusting event. So even though you lost that money after the year end, bring that year's financial statement and do what? Adjust it. So in short, if you see bad debt in a footnote, so bad debt in a footnote or bad debt after the year end, it must be treated as what? As bad debt for that year. So bad debt after the year end, just after the year end. And if that customer, the amount that is owing you is within the receivable, then make provision for it. So that is it. Example 3. Assuming that you've discovered a receipt of purchase, you discover that there was an source document invoice of purchases and sales after the year end. Maybe there are some sales, the invoice, we're not able to receive the invoice, so we did not record it. In accounting, when there's no source document, don't normally record the transaction. But it's made a sale, but there's no invoice to back the recording. This invoice was ready or it was missing. You found it maybe after the year end. In fact, there's clear evidence that these goods were sold before the year end, just that the source document was ready here. The invoice was found here. You kept the invoice in one of the director's drawer, and that director's travel shortly before the year end. Anyone can open his case. So it suggests that, or there's an evidence that these goods exist before the year end, or it has been passed on. Good. Then it also talks about errors. Errors. Receipt of errors of the financial year is adjusting event. Good. Over here, you've read the financial statement. Auditors are working on it. And they realize that you've done a certain mistake or there's an error with the recent financial statement. Then it's an adjusting event. Call for that financial statement and just make necessary adjustments. All the errors, correct them or update the financial statements. So errors or mistakes committed, but just that you realize these errors after the preparation date. Good. Sometimes the auditors that come across them and then draw our attention. You have to update it. It's an adjusting event. Good. We are done. Now let's go to non-adjusting events. We are done with the adjusting events. 2. Non-adjusting events. Non-adjusting events. non-adjusting events. Now, when you talk about non-adjusting events, first the reverse of the adjusting. They are events which occur after the reporting period, but they provide evidence of their existence after the year end. They will tell you that we exist after. Good. But adjusting events will provide evidence of their existence before the year end. We exist before what? The year end. So that is it. So non-adjusting means that transaction, there's an evidence that it does not exist before the year end, rather after or the year end. So what do you do? What will be the accounting treatment? Non-adjusting, as the name suggests. Do what? Nothing. Non-adjust. Don't adjust it. Don't adjust the financial statement. However, if it is material, then you have to make what? Disclosure. Disclosure means tell the users that at the time that we are preparing a financial statement, there's a material transaction which you want to bring to your notice. Full stop. You are done. Or at the day that we are preparing a financial statement, we have made a sale huge, just that we've not published the financial statement too. So I want to draw your attention. You are
But
done.
that makes it contravene the matching concept because it doesn't relate to this. It's
Good.
the other.
Good. Disclosure will, will not reflect in the financial statements. We're just telling them by way of footnotes or by way of like notice or by way of statements. No calculation. We are not going to perform any calculation in the books. So there's no calculation because it's not for this year. So when appearing this year 2020 financial statement, then we now include it in the 2020 financial statement. Good. Now we have to look for examples of what non-adjusting events. Here the examples are not many. There are only what? Two examples. And out of the two, your examiner like one. I'll disclose it for you. So first example is dividend. Let me cite this. Assuming that 2019 dividend, where would they declare it? When the year will end, they'll go for the next or the first annual general meeting for the next year, and then at that meeting, the board of directors will declare what? Dividend. So it means that 2019 dividend will be declared somewhere in January or February. So let's assume that they declare it on 20th January. And even the director will say, okay, this dividend that we've declared on this day is in respect of what? 20 what? 19. So even make that statement clear in exams for you. 2019 dividend was declared in where? 2020. January 20th. Good. Now, is it for 2019 or for 2020? Good. Even though the dividend declared is in respect of 2019, before the year end, is there any evidence that suggests that we are owing dividend? Dividend is not a compulsory. Dividend is the decision out of directors. It's when you make the decision to declare that becomes what? A liability or a provision on you. So before the year end, we can we can go ahead with our operation without what? Declaration of dividend. So the issue is that the standard is saying anywhere you stand to declare dividend for that particular year. So even if I declare 2019 dividend in 2020, it's for 2020. It must be in 2020 financial statement. So it qualifies to be what? Non-adjusting event. Because dividend is a decision. You cannot force the directors that every year declare dividend. So before the year end, there's no indication, nothing suggests that we are owing dividend. There's no evidence that suggests that we are owing dividend. Good. So right after the year, we declare that dividend. It does not mean that we are owing dividend before the year end. No. The liability starts when you make what? The declaration that you are going to pay dividend of 2,000 Ghana cedis. Good. So in short, if you pay dividend after, or if you declare dividend after the year end, it's for the preceding year. So it's for the next year, not the current year, the preparation date. So take note. The last one that we look at for is going concern threat. Going concern threat. Assuming that after you prepare the financial statement, something happened that will impair, or that has impaired your going concern. It can serve as what? A threat to your going concern, which can let you lose business. So how do you treat that? Yeah, assume that you've lost a lot of huge cash as a result of COVID-19. So if you prepare the financial statement December, the 1st December, yes, you done that. And COVID also started in January. January 7th there. Good. So you've lost, let's say, if you've lost all that 3 month sales, January, February, March, all the sales, you've lost it. Good. So if you lost about 400 million US dollars. Good. You can't tell us that this loss is an adjusting event. No, this loss is an adjusting event. So I'm going to adjust the 2019 financial statement. Let me add it to it. I've lost so much. No. This is a going concern threat. So therefore, it's non-adjusting. So the second example is what? Going concern threat. Anytime you realize that there's a threat on your going concern after the year end, it's not. You do nothing. However, you have to amend the basis of preparation. Now, it means that this financial statement, do not prepare it using going concern. Come back and come and use what? Breakup base. Because if in case of material loss, that might that might lead to what? The collapse of your business. So change it to what? Breakup. That your going concern is in doubt. Your survivor is in doubt. So basically, that is it. So anytime after the preparation, after the preparation of your financial statement, you realize that there are threats on ongoing concern, meaning your survivor is in doubt. There are a lot of actions against your survivor. So your survivor, in fact, with that you can make business. Because if you get a huge loss, material loss, huge, to the extent that you don't even know how to recoup these losses. So what do you do? Yeah, we are saying that do not say that, oh, we are going to adjust this financial statement. No, it's not. It's not an adjusting event. It's not adjusting. Now disclose it as a way of note to the shareholders that at the time that we are preparing financial statement, the there was a huge loss pending for payment or pending for treatment. We are done. But change the basis because you prepare this 2019 financial statement hoping that 2020, 2021 too will be successful, but you don't know what will happen. You can even use COVID as an example. COVID have destroyed 2020 for you. Now, the standard is saying that do not adjust 2019 financial statement, but instead change the basis from going concern to what? A breakup basis. Because your going concern is in doubt. Your survivor is in doubt. And you use going concern when you have a good survival point, or use the breakup basis if you know that your going concern is in what? Is in doubt. Use the breakup basis. This transaction, this loss of $400 million, probably you're a startup and can collapse your business easily. So it means that your survivor have a 10% chance. So come back and come and use what? Breakup basis. That's all. No adjustment should be made in the financial statements. We are done.
So it means that the that value was not how do I put it? Was unexpected.
Let's go through some of the questions. Now let's go to success and impuntio. Then we are done with IAS 10, event after reporting period. That one too, there's a drop on it. So kindly check the that one for me. There's a nice drop on it, and then you are done. So let's go to success and then impuntio. So for success, let's check the footnotes. Success Limited. Good. Let's check notes 10, the last footnote for success. Last footnote. Last footnote. It's saying that apart from the interim dividend paid, which is shown in the trial balance above, a final dividend of 3 pesos per ordinary shares was proposed in April 2019. We are preparing the financial statement as at 31st March. So they proposed it after the year end, which is April 2019. So this is what? Event after reporting period. But since it's dividend, it is not adjusting event, but it's what? Non-adjusting. So you do nothing. So that note is not part of the game. So you do nothing. You don't touch it. But why did they place it there? Yes, the trap. Now let's go to Impuntio. Impuntio, that's the last but one. Note 5. And I like the style. I like the style. We are preparing the financial statement for 31st December 2018. That's Impuntio. 31st December 2018 Impuntio. Now let's see. Note 9. A final dividend of 0.5 Ghana cedis per ordinary shares was proposed by the board on 15th of what? February 2019 in respect of 2018 financial year. Have you seen? And now they confuse us that this transaction has not been recorded. So we have to record it, right? No, this is what? Non-adjusting event. So you do nothing. Dividend paid after the year end, even if it's for that year, is non-adjusting. So you do nothing. So this footnote will not be part of the game. This footnote will not be part. So that is it. So this is the end of IAS 10, event after reporting period. Great, we are done. Now let's move on to the next standard. IAS 12, income tax. That's the next standard. IAS 12. Um, IAS 12, very interesting standards. Income tax. But if you want to get a full version, I'll just share the video with you for all the standards. Yes, for all the standards. I'll share the video with you. But just go through those that you've done so far. IS2, IAS 10 and IAS 12. So when the videos are out, you can go to those ones to just get more with income tax. Income tax. Basically, if you mention tax, there are two types of tax. First, some of the tax they are direct, and some of the tax too they are direct on a particular person. Some of the tax too they are what? Indirect. Yes, you don't have a particular person that should pay. Good. Now, indirect tax, we also call it consumption tax. Consumption. Consumption tax. Good. That one you can shift to a different person. Yes. It's only when you consume the goods in the country you pay a tax on whatever you consume in the country. Example include what? Let's give some few examples. VAT. Two. What again? The get fund and then the health insurance levy. 2.5, 2.5, making 5, VAT 12%. So the get fund and then the health insurance. Council talks about all the duties. Mention them. There are three: import duties, export duties, and excise duties. What is import duties? Import duties on importation. When you import goods, good. The taxes that you pay on them, the VAT that you pay on those goods, or the duties that you pay on imported goods. What about export duties? When you do export, right? When the goods are moving from the country, from the territories, you have to pay duties on them. What about excise duty? So when you import, when you export, excise duty is when you manufacture them locally. So locally manufactured goods, the tax that you pay on them are called the excise duties. So we're not doing taxation here, so you shouldn't go into detail at all. We're not doing taxation, like so that is it. Now let's come to direct tax. Here, this tax is on income of a person or a company. That's a direct tax. The incidence cannot be shifted. You can't say, okay, my dad should come and pay my tax for me, or someone else should bear the tax. No, you can't shift it. Unlike the indirect tax, that you can shift it. Good. So examples. Let's see examples. The personal income tax. That's the payee. Pay as you earn. Is an example of what? A direct tax. Another example is taxes paid by what? Companies. We call it corporation tax. Corporation what? Tax. Another one is also called gift tax. I like that. Please gather all the gifts that someone have given you. Go and pay tax on it. Yes, you have to go and pay tax on it. Gift tax. Gift tax. Then capital gain tax. Capital gain tax. Then it also talks about property rate. Property rate. All of these are examples of what? Direct tax. But there's a good news. What's the good news? The good news is that We shouldn't know all these things. No, not at all. We should know only the corporate tax. So IAS 12 only talks about income tax paid by what companies. So how you arrive at what? The corporation tax. That's all. But your examiner assumes that you've done VAT at level 1. That's the only issue here. So the examiner can include VAT inclusive sales, and VAT inclusive purchases in the trial balance for you. So he will assume that you've done it, so you can bring it. So that we are doing income tax, we are not doing VAT here. So that all the sales revenue and then the purchases, it must be excluded, or it must exclude VAT. All the items in the profit and loss must exclude VAT. But VAT is not yours. VAT is the government. So you have to exclude all those ones and do the calculation somewhere. So now that you know that the IAS stuff basically talks about the corporation tax, let's single it out and talk about it. So that's all. They don't need to know payroll, payee tax. No. IAS 12 does not talk about that. So the income tax expense of company, how do you arrive at that? So income tax expense of companies. So the income tax expense that you see in the financial statement. Yes, we've now reached that section. So the income tax expense that you see in the financial statement, how do you arrive at that? That is where we are now. So that's the income tax expense. Great. Now relax. If I calculate the income tax expense made up of three items, you are done. C U V. That's all. Normally it's like oh. Good. C U D. If you add these three items together, you are done with the company income tax expense. That's all. So these three items together. So C, so much. U or D. Put these three together. This will be what the income tax expense you are going to show in your P&L, your profit and loss. You are done. Now I'm going to take our time, go through each of this, and then that's the end of today's section. First, let's look at the C. C. C is the current year tax provision. So current year tax provision. We also call it corporate tax provision for the year. Now, provision can also mean estimate. So we can also tell a corporate tax estimate for the year. Why are you using provision? Can you finalize or can you conclude on a tax that you have to pay? No, the law does not allow that. So, now let me ask this. When you are preparing a financial statement, you have to be faithful. You have to record the actual transaction. So, the thing that we have to wait for what? The tax authority to tell us the right tax so that we can key it in our financial statement. Meanwhile, the same people too, they are waiting for our financial statement so that they can also tell us what the right tax that we should pay. Now we should wait for his friend. So Jerry is waiting for your financial statement so that they can tell you the tax that you're supposed to pay. You too, you're waiting for Jerry to tell you the right tax so that you can use to pay your financial statement. Then it means I have to make a provision estimate in the books so that next year when they confirm, you do what? Adjustment. Or you reconcile your tax. So it means that we have to just make a mere provision or estimate for now. So that's what we call it current year tax provision or current year tax estimate. It's an estimate. So you have to make estimates in the books. Then you are done. Good. Now, in reality, if you want to make that estimate, it's your profit before tax times your tax rate. You are done. That is. But for examination purpose, they'll give it to you. Because if I should tell you that the profit before tax of that company, students are bad, they will strike differences, averages for me. If I tell you this, that means in the profit and loss account, if you work and you don't get that value, you tell yourself that you are wrong. And you should not mark yourself in exams. You shouldn't give you that chance. No. So we take this section out and we rather estimate it for you. So they will give it to you in a question. By you can find it in two places. So this two places. First, it can be the trial balance. If it's the trial balance, it comes with a different name. Yes. If it's in a trial balance, we call it tax computed on taxable profit. Tax computed on what? Taxable profit. Or income tax expense for the year. Income tax what? Expense for the year. That's all. If it's net trial balance, the treatment must be what? Just once. One. So after you bringing it here, it ends there. It doesn't go anywhere again. I'm done. After you bringing it here, that's the end of the game. You are done. Now, that's one scenario. Scenario two, that's the most case. They'll give it to you in a footnote. If it is in a footnote, two treatment. First, after adding it here, so add it to the income tax expense. Income tax expense, meaning here, bring it here. We said that the items in the footnote that are on their own must be treated how many times? Two. So that's first treatment. Two, add it to current liability because a liability you've not paid. It's a provision, tax that you provided for. It's not paid. Or subtract all the tax that you paid on the year from the provision and put the remaining balance there as what? As liability. You are done. So add it there as what? As a current liability. If you have paid any of this tax during the year, what do? You take it off. Because you paid a provision of, okay, I estimated 10,000 Ghana cedis, that would be my tax for the year. But I've paid, out of this 10,000, I think I've paid 4,000 already. Okay, so how much are you owing? I'm owing you what? 6,000 cedis. That's all. So put the 6,000 cedis in your book. That is it. Good. So, and it ends there. We are done for the C, current year tax provision. Good. Now let's go to the U or the O. Then we are almost getting to the end. Good. The U or the O is the under or over tax provision. I normally call it tax reconciliation.
Sorry, there's two. The footnote, you add it to what? What is the relation with it?
You add it to current liability.
No, no,
Add it to income tax expense. That's here.
okay.
The income tax expense. Good. Now you add under or over tax provision. So we have what you call under or over tax provision. Now, assuming that the provision that you made, the following year, GRA will have to confirm it for you. The tax authority will confirm. So either you provide more or less by that amount. Either you provide what? More or less. So I call it tax reconciliation statement. So what do? You compare two items. You compare two items. One, the tax you provided so much to the final or no, sorry. Great. That's I like B. I like Annie. Sorry. So final or tax agreed. You have to see any of these two words there. Final or tax agreed. So the final tax or agreed with the tax authorities. So much. So if what you provided is more than what they agreed on, then it will be what? Over provision. Now, if what you provided is less, then it's called under provision. Good. If it is under, let's assume that you make a provision of 1,000 Ghana cedis. But the tax authority say, no way, I will not agree about this 1,000 Ghana. Your tax must be what? 2,500 Ghana cedis. So let's create under tax provision or over tax provision. So to be what? Under. So to be under tax provision of what? 1,005. Under means the tax that you provided in the book was what? Small. So top it up as what? They top it up as additional expense. So under, you add. What about over? Subtract. So under, you do what? You add. Because an additional expense. You add it to the income tax expense. So that's the tax reconciliation. Good. So under, you add. Over, you subtract. Good. Now let's see. If Jerry say, oh, in fact, the tax must be 800, oh, then that means you provided more than what they agreed on. So you have make an over provision of 200. So you subtract it, you are done. Now, where will you see these figures? Ideally, they're supposed to be in a trial balance. So if you see current year tax in a trial balance, it represents under or over. Just that if it's at the debit side, under means an expense, and all expense have what balance? Debit balance. All expenses have what balance? Debit balance. So under will be at what? The debit side of the trial balance. What name? The name is very important. They will call it what? Current year tax. If you see tax without any discretion, not tax paid, not tax provision, no, just the word tax or current year tax. If you see current year tax in a trial balance, it represents under or over tax provision. But if it's at the credit side, it's a what? Gain. That's the overtax provision. If you provide more. So if you see current year tax at the trial balance, If it's at the credit side, it means it's what? Overtax provision. If you see it at debit side, it's what? Under tax provision. We are done. Now let's back it with what? With illustration. So let's go to success. Success. The same success. One of the notes. Last but one note or so. Good, last but one note. So let me do the reading. Second time. These people. Good. Now let's see. Note 9, success note 9. It says that the income tax of 12 million paid showed neutral balance is the income tax agreed. Wow, agreed is there with the tax authorities and paid during the year with respect of 2018 financial year. Let's check the year. We are prepared for 2019. So always the under or the over tax, because it's a reconciliation, is as a result of the previous year, immediate year. So if you are preparing your financial statement, the current year will bear current year. Sorry, the current tax provision or the current year tax provision. It will bear what? The current year. So if you prepare for 2019, this one will bear 2019. Then the under or over will bear what? 2018. Because you can only confirm last year's tax. You can't confirm this year's tax. You are not preparing it before the tax authority will confirm for you. Good. So that is it. So let's take note that the under over, if you see them mention last year's tax, they are just drawing attention to under or over. Whilst the tax provision was 11.5 million for 2018 financial year, shown in the trial balance above. So the tax that they've agreed, the final one is 12 million, but the tax provided is what? 11.5 million. So let's see. So the workings will be something like this. So tax provided is 11,500. Then final tax paid. So final tax or tax agreed, it was 12,000. So it will create an under tax of what? 500 Ghana cedis. That is under tax. That is under tax. You are done. Just add it to the current year tax provision, and that's the end of the game. Now let's see. Let's continue reading. They said corporate tax for the year. Corporate tax, so that's what? Current year tax is estimated at what? 11 million. That's all. We are done. Now let's go to the last one to finish the game. The D is what? The deferred tax. So let me bring back the last section. We wrote D here, we call it deferred tax. In fact, it must be the movement. Good. So if you sum all this one up, then this one goes to where? The P&L as what? Income tax expense. You are done. So 3 items. CUD. So that's card. That's the acronym for it. Card. Current year tax provision, under or over tax, and what? the deferred tax, then you are done. Good. Now deferred tax. In fact, I'll only perform the calculation here. Then we'll do the some few illustration, and I think we are done for the day. Good. Okay. Now let's see. When you mention deferred tax, you have to go and do workings. Yes. It's the same as the provision for bad debts. Because deferred tax is also provision. You can call it what? Provision for deferred tax. Because the provision. Now, you know that provision is the movement that we record in what? The P&L. So here too is a movement in the provision for deferred tax. That's what you're going to record here. So you do a separate workings. So let's see. You do a workings. So let me take it off to the top small. So you do a workings and tell the examiner maybe workings number 2. Workings number 2. Workings number 2. So we call it deferred tax. Good. First, what you do is this. You look for 2 items, then you are done. Provision for bad debt, 2 items, you are done. Here to 2 items. The open balance, which always it will be in a trial balance. If it's not there, it's not there. We cannot assume any open balance by ourselves. No, if it's not there, it's not there. Dash, you are done. Compare this to that of the closing balance. Compare this to that of what? The closing balance. So closing balance, which will be in the footnote always. So if this is not equal to this, the movement, so we call it P&L, the bracket, the income tax expense. So much, the movement. So this figure will be the one that we are going to record where? Here. This one is the one that we're going to record there as what? Deferred tax movement. And that's the end of the game. Good. So, and here, we look at the few treatments. Great. Just that, unfortunately for us, this is how far the good Lord will bring us. But like I said, I'll forward the full section of this on the platform. Please and please again, kindly go through before next week. Next week, I'll just solve one full question on tax. Then I'll move on to the next standard. IAS 12, 20. Yes, IAS 12, 20, and 40. 11 just 3 standards after here. Then we can go ahead and finish the financial statement. So right after here, 11 3 standards for us to finish the financial statement preparation. Good. So let me give a trial. So do the current year tax provision under over, but leave the deferred tax for me for question 2 and question 3 in Puntio and it's well. So you are doing just the current year tax provision and then the under or over. Leave the deferred tax for me. Next week I will talk about it. But please, I think if you can go through the video for me, I'll be very grateful. Good. So this is how far the good Lord will bring us. Thank you very much for coming. Good.